Hello everyone, my name is Andrew Castleberry. Today we'll be going over the Managing Your Investments presentation. So this is the final presentation for 2023. So if this is your first one you're looking at or you're interested in any of our other videos, please check out all our other videos, look at the video library. It's there for you to use. You can cherry pick what you want to watch, but it's all our past presentations with a bunch of other videos around financial planning as well. So I always encourage you check that out. Now, today, when we're talking about managing your investments, there are a couple key points I want to talk about today, and really what I want to be able to do is answer a few questions. So first off, I want to be able to answer when to invest, how to invest, and why you need to invest. So those are the three questions. So when do you need to invest? How do you need to be investing? And then why should you actually be investing first and foremost? So those are the questions. That's the main goal of what I want to answer today. If you are looking for something that was a little bit more technical, I apologize. That is not going to be this. It's more going to be geared around why you actually need to be doing this and then how you can implement it from a fairly bird's eye view at that point. Now, before we even jump into this first one, I want to differentiate two things. I want to differentiate savings and then investing, because savings and investing are two very different things. Savings is where you build up something entirely yourself. There's really virtually never any growth there. Whereas investing, you are saving, but then you were putting those savings into action and investing them into something. So kind of some key differences here. So in savings really requires you to keep everything liquid. So you need to be able to have access to savings almost immediately. And I say immediately, not like I have money in my hand, but being able to withdraw from a checking account, go to an ATM if you need to. But you're really looking at keeping something liquid. You're not looking at holding something for multiple years before you need to have access to it. You're typically looking at savings accounts, checking accounts, money market accounts, short-term CDs, bank CDs, even like medium-term CDs at that point. And you're looking at principal. You're wanting to make sure you secure principal across the board at that point. So savings is going to primarily only grow by what you actually contribute to it. So you're not putting something into savings and saying, hey, I'm going to let this sit. I don't need to add anything to this, and in 20 years, it'll be a nice little nest egg for me. That is not savings. Savings is, hey, the really only reasonable way I'm going to see any sort of long-term growth on this is if I continue to put money in myself. Whereas investing is kind of the opposite. So investing typically comes from your savings, but you are putting it in for the long term. So you are wanting that money to increase. You are using things that are more long term, like stocks, bonds, real estate, items like that, where the expectation is you will have volatility. You will see that account go up and down, but over the long term, you will see it go up. So when I say up and down, I often like to come back to this chart where you might see it grow, you might see it drop, but you'll see it grow, see it drop, see it grow, see it drop, see it grow. But you notice this is an upward sloping line right here. So it's not linear. It's not every single month you get a certain return. It's over time that money grows. But you're putting yourself in assets that can grow for you. So you are investing in something with the anticipation that you can sit it there for the long term and have it grow and benefit you over time. It involves significantly more risk than savings do because it's not secured principal at that point, but it offers significantly more reward at that point. And you're buying an asset and you're hoping that it grows over time. Now, this doesn't necessarily guarantee that it will grow over time, and we'll talk about how you invest in a way to kind of diversify and provide a level of safety rather than just buying one thing, but it is what you have to do in order to grow. It is almost impossible to save your way to a successful retirement plan. you truly have to invest your way to a successful retirement plan, or you need to have a monster income and save almost all of it at that point. Now, so to start with the first question, which is now, when do you invest? When should you invest? And the answer is all the time. Every chance you get, you should invest. So I show this chart. This is a chart of the S&P 500 from 1900 to about mid probably 2023-ish, give or take. So pretty recently at this point. And one thing you'll notice is it kind of goes up and to the right at that point. So you see growth over a long period of time here, but it's not smooth growth. I mean, we're talking decades and decades and decades of here of growth. You have periods like the Great Depression. You have periods like stagflation in the 70s. You have essentially the 2000s where we had the dot-com bubble and the financial crisis. But you also have periods of growth. So you have periods like the 80s. You have periods like the 90s. And even in periods like the 80s, you had different things that were good and not good for the market at that point. Same thing coming out of World War II, same things in periods of the 70s. You had periods where the market did well, but you also had periods where the market did poorly, and we're talking about the stock market here. So this, again, is an S&P composite, so essentially it measures the 500 biggest companies. But you see that growth over time, but you're looking at, you could have decades where your money does nothing. And you're just saving and saving and saving and saving, but you eventually see that growth. So really, no matter how old you are, or no matter where you are in any one of these kind of periods, you want to be investing, because ultimately you're investing for growth, you're investing for the long term. And even if you invest in like a time period like the late 90s, you still turn out better 20 years later at that point in time. Now, there's always going to be reasons not to invest. So reasons, and I always say that you're going to talk yourself out of it, or reasons to say, hey, I want to get out of the market. I don't like this. Because again, when you look here, there's a lot of ups and downs at this point, but you want to make sure you're keeping that long-term picture, because again, always there are going to be reasons. So like early 90s, we had a recession. You're going to want to probably be like, I don't want to put money in right now, or I'm going to take all my money out. I'm nervous about it. Well, if you did that, fantastic. You probably didn't get back in. You missed some. You have the Soviet Union dissolving in 91. You have essentially financial crisis in 97. You have dot-com bubble in the 2000s. You have 9/11 attacks in 01, Hurricane Katrina 05, financial crisis 08. You have Gulf War spill 2010. You have, so this one's interesting because this one happened, I believe, with Moody's. Actually, this last year, U.S. credit got downgraded from AAA to AA. At that point, you had Brexit, you had a government shutdown, you had trade war conversations, you had COVID, you had inflation reaching 9%. I mean, there are a lot of reasons that you could potentially talk yourself into selling. But one thing I want to note is right up here, if you had just stayed invested this entire time, your average annual return was 9.1% a year on the S&P 500. So yes, there are going to be periods where you're like, man, I don't know, this seems crazy. I don't know what's going on. I want to sell. I don't want to invest. Invest anyways, because ultimately what you're investing in, especially if we're going stock market here, so if you buy a share of the S&P 500, you aren't just throwing your money into a black box. You are throwing your money into an index that tracks 500 companies at that point. So you are putting money in and you are buying shares of each one of those companies. And what you're saying, if you're saying, I don't know what's going to happen, you're essentially saying, I'm pretty sure that all 500 of those companies are going to fail and no longer be sustainable, which means pretty much most Americans will be out of a job. You really won't be able to buy any goods, and we're slipping slowly into a apocalyptic wasteland at that point. It's a little extreme, but that's roughly what you're arguing for, as opposed to these businesses will ebb and flow. You will see innovation come out of high stress moments. Some businesses might fail, but most will continue to go on at that point, especially when we get to this level. And they will learn how to adapt, and they will learn how to continue to make money, because that is their number one job, to continue to make money and show a profit. And you are investing in those companies. So I say, take Walmart, for example. Any one of these crises, are you going to stop buying deodorant? I hope not. Are you going to stop buying food? Are you going to stop driving? Are you going to stop buying clothes? Are you going to stop needing heating and air? I mean, there are going to be things every single time that you could justify a purchase, and there's going to be times companies just figure out different ways to be profitable. So if we look at one of these cycles with a little bit more of like a microscope, you typically see kind of this. You see like the kind of roller coaster ride of emotions. So, and this is where you can talk yourself not only out of selling or buying something, but out of even getting in. So you start to see an uptrend and you're like, oh, well, I'm going to wait, see if the market does like a little bit better. And you're like, man, the market's doing really good. I'm glad I didn't wait to buy. Perfect. And then you start to see, this is just a correction. Maybe I'll buy. Maybe I'll buy. Oh wait, no. Should I sell? I don't know. And then you're like, well, the market's already really low. I'm really glad I sold. So you're like happy that you sold out down here, and then it starts to recover, and you're like, I don't want to get back in. And then you wait, and you see all this recovery, and you're like, well, I don't know. We just had this really rocky period, and you're like, maybe it's a recovery, but I'm not entirely sure. And then finally, like, okay, goodness, I'll just buy. So you're waiting until probably the more expensive period to buy. You're usually like, oh, well, you know what? Like, this is fine. I'll buy some more. And then you see it fall again. You're like, okay, well, I don't necessarily feel comfortable about this. News starts to get a little bit worse. So essentially, you're not even doing this in a vacuum. You're probably hearing people with the water cooler, oh man, my 401k dropped by X%, or I heard this, or the economy's never going to do this, or oh, this political person is doing this and I think he's going to destroy the country, or they're doing this and I think this, or they're doing this and I think this. And you're hearing all of these different things. And finally, like, I don't know. I think the economy is just too crazy right now. I don't understand it. I'd rather just sell. So you sell, but you've probably waited until the worst time to sell. In most cases I've seen, that's typically pretty accurate. Not the worst, pretty close to the worst. And then you wait for way longer to buy back in than you should have. So again, when we talk about when you need to invest, all the time. Every single opportunity to invest is a good opportunity to invest, because what ends up happening is you get to a point and you're like, man, I missed the upswing right here. And you don't think about the fact that there's still decades and decades and decades ahead of you to be invested in. Now, when we think about investing, kind of we've talked about when you need to invest. So you need to be investing. But if you are invested, you also need to stay invested. So staying invested is often just as hard as getting into the market in the first place. And you go through a similar kind of cycle here, where if you are invested, you might sell off somewhere down here, but wait to buy. But it's better, again, just to buy and hold for long-term periods of time at this point. So what we look at here is, if you bought the S&P 500, which again, 500 largest companies in the U.S. in 1999, so you bought it at the top, and then you held it until 2018. So you went through the dot-com bubble, you went through the financial crisis, you went through Brexit at that point, and you ended on a trade war. So some pretty significant things globally. 10 years, which was the worst 10 years since the Great Depression. If you had just held, made a $100,000 initial investment, you would have seen that grow to about $300,000. If you missed the best 5 days, you drop $100,000. So 5 days out of that roughly almost 20-year period, you lose. Best 10 days, you drop again. Best 15 days, best 25 days. So you miss a month, a little under a month. You miss a February, essentially, in there. only you actually lose money over that period of time. And you might say, oh, you know what, that's fine, I'd stay invested. I'd know when the good days are anyways, because they'd be in good times. And if I was going to sell out, I would just be avoiding when everything was really choppy, which is when bad things happen. Well, that's not what does happen. So what you typically see, here's the worst days and the best days. The worst days and the best days are often extremely close to one another. So if you look, some of the worst days were in the best period of the late 90s. Some of the best days were in the dot-com bubble sell-off. There was a ton of best and worst days in 2008 and 2009. And then in COVID, it was some of the best days and some of the worst days were the next day over. And this is something that, like, if you don't understand general market dynamics, it can really hurt you, because what we saw in COVID was you would have a 10% down day that would be followed by a 10% up day. But it's not like you can just sell at the down day and buy at the up day. So like you might have the stock market go down 10% in a day, and you might say, all right, well, the stock market opens at 9:30, closes at 4. It was down 10% today. I sold at 3:30 and I was only down 9. Fantastic. I saved myself 1%. The next day, it's not like it opens that same 9% down and then grows by 10%. It might open already 10% because there's after hours trading, you have institutional trading, you have overnight market movement. So what can happen is you might see the market close at 10% down, but it'll move overnight. So it'll open already 10% up. So you couldn't buy it soon enough. So as soon as you buy, you not only locked in the 9% down from the day prior, but you also missed the 10% bump that day. So you're down straight off the bat 19% just by selling out at the end of one day. And you're down just because you got nervous and you sold. Now, this is why I say it's a long-term thing, because it is much easier to say in theory and say, well, all right, well, I can see a 10% down day in the middle of COVID-19 where, yes, did it turn out to where everything's kind of getting back to normal and life as usual. But if we remember back to March when everything was shutting down, it was sheer panic. People didn't know what was going to happen. We didn't know what was going to happen globally with the economy. We didn't know what was going to happen with our jobs. We didn't know what was going to happen with our health. It was a pretty scary time, all things considered, just because there was so much unknown. And it wasn't until months and years later that we kind of hear a little bit more, we digest what happened. But those early months were just, it was still very much a learning curve at that point, similar to the financial crisis, where early months you had a huge risk of, is this going to be the end of the global financial system? Is everything breaking? There is a lot of nerves, a lot of uncertainty, a lot of just what is going to happen. This seems like the first time this has ever happened. This is just such a monumentous thing. What can we do? That's where you see those huge swings in price in the stock market. And that's where most people, they just get scared and they say, hey, I'm not comfortable seeing my retirement assets swing by $100,000, $200,000 a day, depending on how big your account is, because that's a couple years of income for you in retirement or a couple years salary for you that you're seeing move. But you have to kind of really zoom out and say, all right, we had this crisis. We had this crisis. We had this crisis, and ultimately kind of come back and look and say, all right, well, we had all of these crises, all of these events over the last 20, 30, 40, 50 years where people were in a panic, and you saw the economy continue to chug on. You saw the stock market continue to chug along, continue to find a way to maintain and be sustainable at that point. So you really want to make sure you're not only investing regularly, but also you are investing and staying invested, because one of the best ways to see money grow over time is to stay invested. So what this chart shows is rolling returns from 1950 to 2022. So what this shows is, for stocks, the best 1-year rolling return and the worst 1-year rolling return, the best 5-year rolling return and the worst 5-year rolling return, same for 10, same for 20. So what you notice is, if you look at equities, what you see is on 1 year, you can have a great return or a terrible return. For bonds, 1 year, you can have a great return or a terrible return. For a balanced portfolio or like a 50-50 portfolio, it's kind of the same thing. So 1 year, it's all over the place. 5 years, you start to see, well, a balanced portfolios for like a 50-50 portfolio, really never on a rolling 5 years, never done that bad. Stocks have been down 3% on a rolling 5 years. Bonds have been down 2% on a rolling 5 years. But on a rolling 3, as of 2022, not that bad for a 50-50 portfolio. You go to 10 years and you see, all right, well, there's been a 10-year period since 1950 to 1922 where stocks have been -1. Pretty sure that was the dot-com to financial crisis decade, the 2010s. But you have a much higher likelihood of having a positive return over 10 years. 20 years, stocks are the best thing in town. Worst 20-year average annual rolling return is going to be 6% at that point, whereas rolling average returns for highest years are 17. So, I mean, that's where you want to be in equities, to have that average annual return of 11% over that time frame. You want to make sure you're investing because you're just not going to get that in cash at that point. Now, when we look at that, we've talked about when to invest. Now, how do we invest? So we kind of got into it in that last slide of, do you want to go stocks? Do you want to go bonds? Do you blend of the two? Well, first off, you just want to make sure you're diversified. You don't want to have all of your eggs in one basket. So whether that's a split of stocks and bonds, whether that's stocks, whether that's just bonds, you just want to make sure you don't have all your eggs in one basket. So when we talk about that, diversification can look a lot of different ways. This would be a chart of diversification in stocks. Some of you might have heard this is like the jelly bean chart because it's got a bunch of different colors on it. But what you're looking at here is these are the main sectors of the S&P 500 since 2013 to 2022. So what you'll see from 2013 to 2022, the average annual return and then the volatility. So that's how much change they have over time. So it's no surprise information technology has done the best. Communication services is relatively new, so you don't have a ton of energy's done the worst. Then you have real estate, materials, consumer staples, utilities, consumer discretionary, industrials. But what you'll kind of notice here is like healthcare's done really well, but it's also been really, really volatile because you have healthcare doing really well here, worst one here, better here, best one here, second worst one here. And it kind of goes all over the board. So you want to make sure you're diversified because what you'll notice is if you were to take just a combination of them in light blue here, so the S&P in blue here, it's the third best. It's also the fifth least volatile at that point in time. So, I mean, it's sitting there and it's the smoothest ride for a really good outcome there. So you want to make sure you're diversified because you want to ideally be purchasing something that's doing well while something else you have is doing poorly, because no one has a crystal ball and no one can say, hey, this is always going to be the thing that's on top. Because if you look at this, like this is just a picture of the S&P 500 for one day, but it's a great example of you have a lot of green and a lot of red. Like if you were sitting there and you're like, oh man, well, Walmart's always going to do well. It might not always do well. Utilities might not always do well, but you might have grocery doing well, you might have banks doing well at any given day. So you want to make sure you're spreading what you're investing in out over different sectors or different companies. So when I go back to kind of what we talked about a little bit earlier, which is you want to make sure you're buying something for the long term. But there is so if we go all the way back here to the difference between saving, involves taking risk in hopes of earning a return. Well, in hopes of earning a return, that's when you need to start looking at how you invest in order to make sure you're being diversified. Because you can buy a single stock in a single company, but if that company goes under, which companies go under all the time, if that company loses to competition, which companies lose to competition all the time, you are stuck in that one company. But if you buy something like an index, like an S&P 500 or something similar to that, a mutual fund or an ETF that holds a basket of stocks, well, if one of those 500 stocks goes under, guess what? You have 499 other companies that didn't. So you have a layer of kind of protection around your holdings based on just sheer size at that point. So diversifying can help limit your risk a little bit. So it might not hit home runs every single year, but you're going to get a consistency that you would not get out of a individual holding at that point. So you want to make sure you're diversifying. So right now we've talked about just diversifying in companies or sectors that you're talking about, but you also want to look at diversifying potentially internationally. So what this chart shows is, all right, in purple, you see when international markets have outperformed the U.S., and in gray is when U.S. markets have outperformed international. Now, for like the last 10, 14, 15 years, U.S. has dominated international, except for like the last year and a half, 2 years. International's actually started to do pretty well. So it's one of those things where it's very hard to look past recency bias and say, hey, well, U.S. has always done well, but there will probably be a period where international might do better than U.S. for a small period of time or a longer period of time. But traditionally, you see them kind of pass back and forth. So there's a decent justification for wanting to have some of your assets diversified internationally at that point as well. And again, you can do this in mutual funds, you can do this in ETFs, you can do this in indexes, individual stocks if you want, individual bonds. It's something that if it's not your cup of tea, you can use a target date fund in your 401k, like a T. Rowe Price retirement fund or a Vanguard fund, or like a Fidelity, I think Freedom Fund. So you can use those and they'll do it for you. You can use robo-advisors. You can use advisors like us that can help with that. But so that's diversification. You want to kind of spread your risk out. Now, when you spread your risk out, now it becomes the conversation of, all right, well, where do I actually put that? So that's when we have the conversation about asset allocation. So think of diversification as like kind of the top line layer of like, I want to invest, so I want to make sure I'm diversified. Now, when I think about diversification, where do I actually put everything? What do I actually need to think about? What do I need to do in order to make sure I'm putting my money where I need to put it for the type of risk I need, the type of reward I need that's going to fit my plan? What does that look like? So you can kind of do it in a very simple way of just some people base it off of age. So like this is a lower risk person or a higher risk person. And depending on what age group you're looking at, you either have more bonds or less bonds. So like a younger person might not have any bonds. They might have some bonds if they're slightly risk averse. Whereas an older person might have a lot more bonds and a lot less stocks. Stocks tend to be a little bit riskier, a little bit more volatile. Bonds tend to be a little bit stabler. So you want to look at kind of first off high end of, all right, well, where is my risk? How much risk do I want to take? How much risk do I need to take? How much risk am I comfortable taking? Those are some questions you want to ask yourself. And if you don't know how to answer that, or if you don't know, well, how much risk do I need to take? Build a plan, meet with someone, have them build a plan, have them map out what it looks like, and compare and contrast different strategies based on that. So then you want to say, all right, well, if I want to dig a little bit deeper, how do I actually do that? So I have, let's say I want to do 40% stocks and 60% bonds, or 60% stocks and 40% bonds. What stocks do I choose? What bonds do I choose? Then you get into something called this. This is called a style box. So think of style boxes. You have large value companies up here, large growth companies up here, mid-sized companies, small companies. Same with fixed income. So you have short-term higher yielding bonds, and then short-term lower yielding bonds, or short-term lower yielding bonds, and then long-term lower yielding bonds. So you have kind of a range. Ideally, you don't want to pull this up and have everything be kind of shaded in just one of these boxes. You would like to have a blend between all of these boxes. So you would want to hold a basket of stocks and a basket of bonds that is going to cover all of these boxes Might have leanings some way or the other, but you generally want to have a little bit in each one of these. And when we talk about these size companies, I want to give you examples. So if we look at large growth, think Netflix, Salesforce, Nvidia, Uber, Facebook, Google. When we think mid cap, think DraftKings, Etsy, Wayfair, Peloton. When we think small growth, LendingTree, Stamps.com, Papa John's, Wingstop, Overstock. So we're not talking, when we say small, like small companies here, we're not talking about the mom and pop down the street. I mean, these are still massive companies. We're just talking about smaller in the terms of like big publicly traded companies. When you think growth versus value too, so if we go back over here and we say, all right, well, what's growth and what's value? A large growth company might be a Coke or a Pepsi or a Walmart rather than an Nvidia or a Salesforce or a Netflix. So think of these as growth companies tend to be slightly newer, still, and I say slightly newer, I mean, we're not talking about like days, but maybe like decades here, still in kind of full growth mode. One thing on here I think would kind of be interesting because this is in 2021. I think over the last 2 years, Facebook might actually be categorized as a large value company now. It's kind of slowed its growth a little bit. And that's not to say it's no longer growing. It's just not necessarily its number one focus. So it might not be throwing all of its money into essentially like research and development. Value companies sometimes pay a better dividend at that point. They're a little bit larger, maybe a little bit slower moving, just a little bit stabler in some ways. So what you typically see is like the performance can be a little bit lower over time at that point. And again, a mid-sized value might be Kroger, Campbell's, Best Buy. Small value might be Big Lots, Goodyear, H&R Block. So still looking at really big companies, even on the small sides, just slightly different in the way that they're managed, slightly different in the way that they're growing. But you look at this and you might say, well, why would I ever own value stocks? Because growth stocks do really well. They have a better outperformance, especially during this period. That's also not always the case. So you have periods of time where value outperforms growth. So growth has outperformed value since really the financial crisis, but value pretty much very aggressively outperformed growth in the early 2000s. Growth outperformed value in the late 90s. Value outperformed growth in the mid 90s, and then vice versa. So you see a trade-off. And if you kind of look at this, it's kind of similar to when we looked at international to U.S. So there's a reason you want to kind of diversify and then within that break out your assets, because it's not always going to be what's worked over the last 5 years or even the last 10 years works in the next 5 years or in the next 10 years. Again, no one has a crystal ball. So you just want to make sure that you are kind of broadening the way you're invested to give yourself, one, kind of an even road, but two, a smoother road at that point. So if we look at this from 2008 to 2022, so if we take a blended asset allocation in white, similar to the chart we saw a little bit while ago about the different sectors in the U.S. growth, this is just looking at large cap, small cap, international stocks, cash, fixed income, high yielding fixed income, commodities. So essentially a blended portfolio would have a little bit of all of these in it. What you can kind of see is it's never the best performer. It's never the worst performer. It has an average annual return that's the fourth best at that point, and it has a volatility, so how much it went up and down, that's the third worst. So again, it's not going to hit home runs for you, but it's also not going to be all over the place for you. You might you might have a guy that hits home runs, but he only does it every 20 at bats, which would be great, I guess. I'm not a huge baseball guy. I think that would be great. But you might have a guy that gets singles, but he gets singles and gets on base potentially every 3 at-bats. You might want that a little bit better. So really, when you're talking about asset allocation, what you're getting is you are wanting to hit singles and get on base very consistently, not have the, oh, well, we were the best performer one year, only to be in the bottom 3 the next year. You want to be a lot more consistent than that over time at that point. And you're probably asking yourself, this is a lot of information. How am I supposed to do this if it's not something I enjoy or not something I want to spend a lot of time researching? And if you have a 401k, it's one of the easiest ways to get invested. It's one of the easiest ways to invest consistently over time. You're also more than likely going to have a target date fund. So what a target date fund is it marks a future point in time, typically like a retirement date, and you will have a more aggressive allocation over here, so maybe more stocks, less bonds, and then as time goes, you will start to have less stocks and more bonds at that point in time. So it slowly gets more conservative. To put it like slightly different way, is you get closer to your retirement year. So if you were like 5 years out, 10 years out from retirement, 15 years out from retirement, you might be really aggressive. And then as you start to get 20, 15, 10, 5 years out, you'll notice this fixed income portion and the short-term portion start to really grow. And that's because you're getting more conservative the closer you get to needing to withdraw those funds. So you're in a diversified portfolio in equities and fixed income. So this is going to be diversified within multiple types of stocks, but you are just getting a kind of general trend to be more conservative. So you don't have to worry about anything from an investment standpoint. You just have to worry about making consistent contributions, which is pretty fantastic. It's a really easy way to invest and a really easy way to make sure you're staying diversified. So then all you have to worry about is consistency. Consistency is key. So to look at this, this is why consistency is key. So this is going to show really 4 different savers. So you have the consistent saver that starts at 25, puts $200 a month in every month until they retire at 65. Then you have the person that starts at 35, does the same thing. You have a person that starts at 25 but stops at 35. And then you have the person that starts at 25 but's really conservative with it. Like they are focused more on savings and less on investing at that point in time. So one thing you'll notice is the consistent person that starts early, best bet. So 80% or 81% of their account balance at the end of their life is growth. So they saved $96,000. Again, this is $200 a month, saving $96,000 over all of it. Most of it's growth, and they have a pretty nice portfolio. The person that started 10 years later has about half of what they have. Same return, little bit less savings, not half of the savings, but less time to invest. So again, this really gets into if you can start early, and we have more videos talking about kind of percents you need to save if you start early in some of our retirement presentations. I'm not going to get into that as much here since we're going more investment management. I want to talk more about the consistency and the return side of it. Again, someone that starts early, though, it's about the same, just having that 10-year extra lead, even if they stop at 35. But the one I really want you to focus on is the person that's really geared more towards savings. So investing might make them nervous. They don't like the volatility, but it's necessary. And here's where you get to the point where they save $96,000, but that's most of what they have at retirement at a 2.3% rate a year, which is maybe what you got on cash, like a high yield savings account or like a CD or something. It gets you to 158, but I mean, you're not retiring for 30 years on 158,000. You're just not doing it, period. So you need to make sure you are investing. The other thing is you're going to see that take some time. So you notice this blue line really starts to tear up quickly and get very steep this last decade or two. So when you're investing, it takes time for that money to accumulate. But once it starts to accumulate, it's going to grow significantly quicker, not at a percent rate, but at a dollar rate. So this is someone that is investing $10,000 annually and having a 7% average annual return. So it's extremely basic. It's very unrealistic with what you would see from a real return and the volatility that you would naturally see in the market, but it does a great job of kind of showing how compounding starts to work. So from 0 to 100,000, it takes you a little under 8 years. For the next 100,000, it takes you only about 5. The next 100,000, it's a little under 4. The next 100,000, it's just over 3. Then the next 100,000 is 2, 1 and a a little over 1.5, a little over 1.5, 1.5, less than 1.5. So in the time it took you to get the first 100,000 is about the same amount of time, give or take, it takes you to get, let's see, that's about the last 500, like probably 480,000. So this back half happened at about the same pace it took this first half. And that's what's difficult is a lot of people will get to this 12 to 17 years in and say, man, it's been mostly my contributions. This really sucks. Why am I doing this? And they don't give it time to continue to build and grow. And that's why if you start earlier, this still is a valid time, but you still have maybe rather than from 45 to 55 being your last decade, from 55 to 65 to really see that ramp up and grow. So you want to make sure you're investing consistently and staying investing consistently because it takes time for that money really to compound and grow there, because it's still growing at 7% every year all the way across. But 7% of 800,000 is a whole heck of a lot more than 7% of 100,000. The next is you don't have to do it all at once. So a lot of people are like, well, I can't just jump in and put 10% away. You can do gradual increases. So this is someone that started at 25, did 10%, or someone that starts at 25 and does 3% to start with, but then increases it every year by 1% until you get to 10%. And there's not that much of a difference. It's 2 million to 2.2 million. So really not a huge difference there at all of similar returns, same exact scenario, just one person starts at 3% and adds 1% a year until they get to 10%. It's still a very, very good return ultimately. So I say that to say what you end up seeing over time is that being able to just contribute consistently, staying invested, and then consistently growing, you can get to retirement with a decent chunk of change at that point and a very successful retirement plan. So lastly, I want to talk about why. Why do you need to invest? And the biggest thing is probably inflation. Inflation is a constant across the board. So it's been really in the news lately, probably more so than it's been the last 20 years over last year, because inflation got to be 9%. Now, what inflation is, it's a measure of change in value. So you might hear, oh, well, inflation's died down, but things are still really expensive. Well, yeah, because the rate of change in which things are getting more expensive has dropped down, but that didn't mean the prices dropped down. So we didn't have deflation. We just had disinflation, where inflation is lowering, but prices are not lowering. If we get deflation, prices would be lowering. So what it kind of shows is inflation over time changes. So we got deflation in the 30s, where things like a dollar actually started to go further, but everywhere since then, a dollar has become less and less valuable. So a dollar that's worth $1 in 1930 is worth a little under 10 cents in 2019. So what we've seen over the last really 20 to 30 years is inflation's been very low, but it's been pretty constant. But it will erode your purchasing power over time to where $10 today is not going to be worth $10 in 10 years or 20 years or 30 years at that point. And it doesn't hit the same for everything. Like some things have gotten substantially more expensive, whereas some things have gotten actually a lot cheaper. So like since 1998, like you see general household goods effectively about the same price, like cars, apparel, household furnishings. Like the dollar values have changed, but like proportionally, like they haven't changed that much. Hospitals, colleges, college textbooks, nursing, essentially healthcare related or education related has gone up tremendously. Things like TVs, computer software, cell phones, they've actually gotten a lot cheaper. So it's going to affect everything. Like food's gotten more expensive. Wages have gone up a little bit though, which is kind of nice. So there's a lot of things that kind of ebb and flow within that inflationary number. It's not going to be a smooth, oh, inflation was 1%, everything in my life went up 1%. It might be some things got cheaper, some things got more expensive. They average together to be 1%. But ultimately, what you need to think about when you think about inflation is if you had $100 today, in 10 years on a 3% inflation rate, that's going to be worth 74. In 20 years, that's only going to be worth 55. In 30 years, it'll be worth $41. In 50 years, it'll be worth $23. So to have the same purchasing power, the same equivalent buying power of $100 today, 50 years from now, at a 3% interest or 3% rate of inflation, you probably need to have somewhere around $440 for the same purchasing power. You're not going to get that from savings. If you just save and you don't invest, you're going to see those contributions build up. So you see a contribution, oh, great. Well, I saved enough and I got $192,000 because I saved every year for 40 years. Awesome. If you were able to get that, and again, this is average 10%, but get that and invest that same savings amount, but invest it rather than save it, you see a significantly higher number here. Regardless of what that return is, it is going to be higher over that time period than what you could have possibly saved. Now, again, to talk about it, you're going to see that 12 to 17 year mark right here where you start to see those contributions or that investing really pick up. But it's always going to end up being better for you long term than just saving cash. You cannot save enough to retire. If you are trying to, you are going to have to dramatically save a disproportionately large amount of your income and not only live frugally, and I mean, excuse me, frugally now while you're working, you are going to have to continue to live extremely frugally in retirement and hope you do not have emergencies come up. Hope you do not have unexpected car problems, unexpected health problems, unexpected home costs. Hope that you don't have an inflationary spike. There's so many things outside of your control, and you can only save so much. You need to have some sort of investment growth on there, because even if you're saving and you are saving over a long period of time, not only is that money not growing for you, but life is consistently getting more expensive for you as well. So not only is what you have in the bank losing value every year and probably not keeping pace with inflation, it's not going to be something that you can add to enough to do that. You need it to be working for you, or you will more than likely be working for the majority of your life and either live to where it's only Social Security, to where you are just having to fit your entire life to a Social Security payment, or just continue to work as long as you possibly can. And lastly, I just want to end on this. I liked this little visual just because it's something where investing once doesn't make you rich. It's consistency. It's the same way as exercising won't get you fit. Reading one book won't make you smart. It's consistency. So I cannot stress enough when we talk about how you need to invest, when you need to invest, where you need to invest, why you need to invest, it's consistency. So if you can keep a diversified asset allocation approach, spread your funds out, use a target date fund if you need to, reach out to a financial planner if you need to, reach out to us. We can help set up an investment strategy for you, help build a plan to make sure you're saving enough at that point. We can help with all of this, but it's something that you need to make sure you know it's consistency and it's long term. It's not done in a day. It's not done with 1 year's performance, and it's not lost with 1 year's performance. It's done over a lifetime to build a solid, really well-rounded financial plan. So please feel free to reach out to us. Again, for all Forsyth County employees, it is completely covered by the county under your benefits. So reach out to us at MyRetirementPlan at investplanadvise.com, or this is my number for Forsyth County employees. Other than that, check us out at investmentplanadvise.com. We're investment planning advisors. But thanks for listening. Check out our other videos and have a great day.